Welcome back to this course. This is a video based on Lesson 3, Module 2, Lesson 3B, and it's on SMT Diversion. I just wanted to show you on a chart what that sort of means. So SMT diversion, like it said in the text, is basically an inverse correlation between the dollar index and every other asset type that doesn't start its dollar as the base currency, because that would be basically mean it's the same thing as the dollar. But yeah, the dollar index XMT diversion, some have described it as one of the most powerful confluences we can have to sort of back up our higher time frame bias. But it is a powerful confluence. It is a powerful sort of tool that you can use in solidifying your trade idea. So basically, I'm just going to go over what that means. And I usually check for SMT diversions on the 1 hour chart. I don't spend a lot of time on the 1 hour chart as I do on my other high time frames. When I get on here, I look for intermediate term highs, like he explained on the texts of the first part of lesson 3. I look for intermediate term highs, intermediate term lows, and then I look for SMT diversions. And I would show you what a inverse correlation SMT diversion means on the in relation to the dollar index and the euro dollar in this situation. I could do this with the dollar index or the pound dollar index or Aussie dollar. So right here is just an example. So let me just go through what I'm talking about. I have a small diagram right here just to sort of explain what this means. So the inverse correlation is basically when the dollar index is making a higher low, the euro dollar should be making a lower high. So just like an inverse correlation between the dollar index and this asset type, right? This pair, when the dollar index is making a low high, the euro dollar should be making a higher low. So there should be an inverse correlation between the two of them. Now, if there's a crack in this inverse correlation, there's a crack, say this happens, say the dollar index makes a high, but the euro dollar fails to make a lower low as it should. It means that there's buy pressure on the euro dollar right here. This scenario right here means that there's a buy pressure on the euro dollar, and that would give you a strong indication that you should be going bullish on the euro dollar. Now, for a sort of in the inverse of that situation right there, inverse situation, say the dollar index fails to make a high when the euro dollar was making a lower low. Both situations, this situation right here, this would mean that the dollar is weak. And when the dollar is weak and when the dollar is going down, and this is a concept called risk on situation. It's a concept called risk on right here. Risk on means dollar down, everything else goes up. Risk off means dollar up, dollar is going up, dollar is bullish, and everything else is bearish. Every other asset type is going down when dollar is going up. So risk on, risk off situation right here. So right here, this is a risk on situation, meaning the dollar is weak and euro dollar has strength. There is a bullish bullish orders being placed on euro, and euro should be going up in this situation. So that is what a SMT diversion simply means. The inverse correlation between the dollar index and every other asset type. All right, so let me show you just a quick example on the chart. An example on the chart right here. So it's really straightforward, really. Right here is your SMT diversion. It's an SMT diversion. And why is it an SMT diversion? It's an SMT diversion because here we see that dollar has made a higher high and euro has failed to make a lower low as it should, because there should be a inverse correlation. But right here, this is a secret. This is a secret in trading, in this concept. A very, very powerful confluence that you could have that indicates that euro is going up, because it doesn't inversely correlate to the dollar index at this particular time, 9 a.m. in the morning. It doesn't inversely correlate to what the dollar index is doing. This means, as it doesn't create a lower low, this means it didn't sweep this low. This means that the buy orders, strong buy orders being placed on euro. Euro is being bought, and that's why you can see a bullish run right after. So when this happens right there in this at this point in time, you would be locked and loaded to take buys. You would have had higher time frame bias that price is going up on higher time frames. This is just a added confluence. And when you see this, all doubts, everything else that should be telling you that, oh, you might not be correct, you might not be right about dollar being bought. When you see this, all those doubts just go away, because the SMT diversion is just a very serious confluence that you could have, that you could add to your already predetermined bias on higher time frame right there. So that is basically what a SMT diversion is. There's another version of SMT diversion. I'll be showing you right now a second example of an SMT diversion. But right now, the sort of stronger form, the stronger concept of an SMT diversion should be looked at in the inverse correlation, the inverse relationship between the dollar index and every other asset type that doesn't begin with the dollar as the base currency. All right, so this is a second example of an SMT diversion. The first example was the inverse correlation between the dollar index and other asset type that doesn't have the dollar index as the base currency. But in this example, I wouldn't be talking about an inverse correlation, but rather a similarity between asset types that don't have the dollar as the base currency, but rather have it as the minor currency, like the pound dollar, the euro dollar. You could also compare the pound dollar and Aussie dollar. They should be moving in tandem. They should be moving in correlation, right? So I have a diagram that sort of explains that just a little bit more. So this represents euro and this represents pound dollar. When the euro dollar is making a lower high, the pound dollar should be making a lower high. And when the euro dollar is making a higher low, the pound dollar should be making a higher low also. When the euro dollar is making a lower low, the pound dollar should also be making a lower low. So that is the correlation that these asset types have. But when there is a crack in that correlation, say there is at this exact same time, right? There is a formation of a lower low on pound, but the euro dollar doesn't make that same lower low. This is an indication that the euro is being bought. There are stronger buy orders on the euro dollar, right? This should indicate that there is a reversal from a downtrend, a reversal into a buy, or there is a bullish run coming right there, just because there is a crack in the correlation between these two asset types, right? So I also have an example of a market condition right here. We see the movement. We see euro making a low here. We see that low being swept just a little bit, but there was more of an exaggerated sweep on the pound dollar, right? There was more of an exaggerated sweep. That's giving me an idea, or I already have the idea that there is a bullish run coming, because there's a crack in the correlation, right? It should be making a more exaggerated low than this. But then if you had any doubts after that, there is something happened just a few hours later. The pound dollar made a lower low that the euro dollar failed to make right there. And right there, you have your SMT diversion between correlating pairs right there. And that should give you a hint, a confluence, and like the first example stated, I searched for these on the 1 hour time frame also, even with correlating pairs. That should give you a confluence right there that these asset types are going bullish. There's a bullish one coming, and that's exactly what happened. They bought right after that. So it's just a confluence that to sort of back up your higher time frame bias, right? The SMT diversion. So that's basically what it is. Look for it on the 1 hour time frame, and it just helps me solidify my higher time frame bias.